Well, hi everyone. Today we're taking a look at an alternate version of exercise 7-10 on page 343 of the textbook, chapter 7, reporting and analyzing receivables. Today we're taking a look at a note receivable transaction. So the problem reads, prepare journal entries for the following transactions for Denisha Company for 2015. On December the 13th, they accepted a $15,000 45-day 9% note dated December the 13th from Miranda Lee in granting a time extension of her past due account receivable. So that tends to be a pretty common thing when customers run into problems that they can't pay as due. We'll sometimes take that account receivable balance and flip it into a note receivable, where we'll actually collect interest now from money that they owe us. It says on December the 31st, adjust the year-end accounts for the accrued interest interest earned on the Lee note. So notice this is a 45-day note taken out on December 13th, but we want to be able to accrue interest through December the 31st. So let's take a look at the journal entries. Now the first entry is to record the note receivable. We have an amount that Lee owes us for $15,000. So we have a new note receivable for $15,000. But wait a minute, wasn't this a previous account receivable? Well, yeah, it was. Do we still have that account receivable? No, we're getting rid of that. So that previous account receivable showed a balance of $15,000 as a debit because receivables are an assets. Assets have normal left side or debit balances, right? So to get that to go away, what do we have to do? Give it a $15,000 credit. So the first entry is to get rid of the old account receivable and turn it into a new note receivable. The second part of the entry is then to determine what is the amount of interest income that the company really earned on this note for the month of December. So we're going to have some interest revenue and interest receivable. The interest revenue is calculated like this. We take the amount of the note, which was $15,000. We multiply $15,000 times the interest rate on the note, 9%, and we multiply that times the number of days out of a 360-day calendar year that the money was owed. In this case, that's the difference between when the note was issued to the end of the month, or 18 calendar days. So 15,000 times 9% times 18 over 360 gives us interest that is due of $68. So therefore we have interest revenue of $68. But why are we not debiting cash here on December 31st? Why are we debiting instead a new asset called interest receivable? Well, when does the customer pay off this note? In 45 days. So in 45 days we'll get the total $15,000 back plus interest for the entire 45 days. Well, that's all going to be $15,000 plus interest for the entire 45 days of $169. So we'll get later on in the period $15,169. Since they're not paying that off to us now, this interest that accumulated for these 18 days, we're going to create this thing called an interest receivable. That's money we'll receive in the future. How many days in the future will we receive it? Well, 45 days after the issuance of the note.